Let's talk about WeWork. It's in bankruptcy court. A New Jersey court recently gave it back to its creditors and essentially ignored your bid to buy it back. Is that the end of the story for you and WeWork?
So we're, first of all, thank you for having me. And we're just at the middle of all of it right now. But just to explain a little bit more about it. Our bid was $650 million. The bid that seems to be the one that they're considering to confirm at the end of the month is $400 million. It's a difference of $250 million. That number is very important. I'll explain in a second why. When in bankruptcy, and I'm learning a lot about it, I've never heard anything about it before, so it's all new. I didn't think bankruptcy was a beauty competition. I thought bankruptcy was...
That is a line in your brief.
Yeah, it is a line in the brief. I thought it was whoever is going to give the best offer. And when you base, well, what is the other offer? What's the plan that they're showing? So they show a plan and they give numbers. And just to share a few numbers in the plan that's going to be presented to the judge at the end of the month, the plan says that the average, two numbers that are very easy to track, average revenue per member and occupancy. The two numbers that the current plan is forecasting would be the highest numbers we have seen since 2019, which is as far as we can go, which I would call peak office, and would hockey stick, and they would have to achieve those numbers by the end of this year. I'll say a little more. The profit margin of the buildings would have to go from 16% margin, which is the last number that we saw right before it declared bankruptcy, to 24%. That is 50% growth in margin by the end of this year.
And this is under your plan or
their plan?
Their plan.
No, their plan.
So you're saying it could be hyperbolic.
Oh, I'm saying it's definitely unfeasible.
But let me just ask you, I mean, don't the creditors have a legal requirement to take the best deal? So is there something, and you said it's not a popularity contest, so if it was, why, if they looked at your deal and perhaps had a legal requirement, and a very self-interested requirement to take the best deal, why do you think that they have bypassed?
So we're getting very technical, but let's say one.
I don't think it's a technical question.
Well, it is, because your real question you're asking is the judge obligated to take the best deal, or does the judge get to choose what deal he's going to take? And I think it gets quite technical, but let's say something else just about, back to what I said, from 16% to 24%, 50% growth in 1 year, without spending any money on on a business that now has aging buildings, in what I think is one of the worst office markets, maybe in the history, but definitely of the past 40 years. Look around just here in San Francisco, but it's a global phenomenon. If they achieve these very rosy plans that I think are unfeasible, they would then need to, in 2025, grow from that to not go cash flow negative. What I'm really telling you is that the plan that they're planning to approve, or if they approve, it hasn't happened, would be a plan that takes the company cash flow negative less than 12 months from when it came out of bankruptcy. And we're planning to show it in depositions. We have a chance to the confirmation, and you can take it as far as...
Okay, so this isn't over.
This is not over.